Good evening and welcome to tonight's session of the Covered Options Online Learning Club. Once again, I'm Paul Madison and I'm your host for the Cool Club. If you want to contact me, you can write to me at the Cool Club discussion list, cool_club@bivio.com. Again, our little disclaimer, you need to understand that options involve risk and are not suitable for all investors. So bear that is in mind as you're listening to these discussions. What is Cool Club? Just a quickie, this is a weekly 30-minute session where we explore the thought processes associated with actual covered option trades. Here's our September schedule along with some projected topics as well. So this week we're going to be doing opening covered options on index ETFs and presenting the new Cool tool. And next week we'll be using that same Cool tool, but we'll be looking at closing covered options on index ETFs. Next week will be an hour later. It'll be 9 o'clock Eastern. And then the last week of this month we'll do a little something different. We'll finally get to meet that rascally Mr. Volatility. So it should be fun. We're continuing to build out our Cool Club page. It's at bivio.com/cool_club. Both handouts and recordings that I was just talking about are under the presentations link. You can join our email discussion list here. You can get the Cool tools, the covered calls, cash secured puts, and the third one that we'll be talking about tonight for index ETFs is also out there now. And finally, to check the schedule and register for the sessions, you can go under the meeting dates and times. Let's see, for tonight we're going to do a little bit of a refresher on selling covered options on index ETFs. We're going to delve into a bit of statistics. Don't worry, you don't have to do any statistics. Then we're going to look at the new index ETF Cool tool. As always, we'll walk through some examples. We're going to revisit our Coach cash secured put that we sold in August and has now been closed. And then we had some great responses today on our homework assignments, and we're going to go through those. And we should be done around midnight or so. No, I'm just joking. Hopefully it'll be the same kind of, probably a little more than a half hour, but hopefully less than an hour. So we're going to talk covered options on index ETF. Quick word of caution, you may hear me use these terms interchangeably, broad market or index or ETF, and the true actual right phrase should be broad market index ETF, but that's a lot to type and it's a lot to say. So if you hear me say just one of those, I mean the whole concept, and so just remember they're all the same things when I'm talking about them. Kind of some reminders about covered options. Something that is really hard for people when they start is the fact that your whole mindset is different. When we are dealing with stock, we always start by buying, and then at some point we sell, or hopefully we do. When we are doing covered options, we have to think backwards. We start by first selling, and then we have to close the option, which often means a buy. And then we've got another little reminder. This little picture may help us to remember that if you're selling covered calls, they can turn into sells. And if you're selling cash secured puts, they can turn into buys. All right, so the housekeeping stuff's out of the way. Let's get into the index ETFs. And let's start by saying logistically, selling covered calls and cash secured puts on index ETFs looks identical to selling covered calls and cash secured puts on stocks. But for me, it is how one plays them or what they use them for. That is where the difference lies. Traditionally, we have all had some amount of cash in our portfolio. That amount might vary in size depending on how bullish or bearish we are about the market, and can also vary depending on other things going on in our own lives. This is the money that we are not looking to be in the market but rather generate some amount of interest. Interest rates on that money used to be fairly reasonable, maybe even as much as half of what we expected our stock returns to be. And we were comfortable not getting price appreciation, but just a reliable, constant income stream. But these days, our interest on the cash portion of our portfolio is almost not worth talking about. So far, they're not charging us to hold our cash, at least not in the U.S. Europe is another story. It just seems like there might be a better place to put our money. But I believe done properly, covered options on index ETFs can somewhat take the place of our low-risk, reasonable interest rate portion of our portfolio. And as you've heard me say a number of times, my two favorite indexes are SPY, which is an ETF that emulates the S&P 500 index, which represents the 500 largest U.S. companies. And the other one is IWM, which is an ETF that emulates the Russell 2000. And I'm afraid I've misrepresented what the IWM was on some previous occasions, so I need to, at this point, correct what it actually is. The IWM is the bottom 2,000 smallest U.S. companies in the larger Russell 3000 index. It is a small cap index. The median market cap of the companies in the Russell 2000 is just over 500 million. That was sometime in the middle of last year. The average market cap, so I was talking median, the average market cap is over twice that amount. So that tells you there are a lot of really small companies that pull that median down. So what is different about covered options on index ETFs versus stocks? When we do stock, we should be doing fundamental analysis that tells us where we think the stock is undervalued, which we call our buy target, and where it begins being overvalued, which we call our sell target. And we would expect that there's a fairly respectable difference between these two numbers. We should be desiring to buy it when it is undervalued and sell when it is overvalued. Our biggest gain should come from price appreciation. Selling covered options can add some return on the edges, but it should be the smaller amount if we're sticking to high-quality growth stocks. I cannot stress enough that for at least me, fundamental analysis is the key to stock investing and on doing covered options on stocks. The way I approach covered options on index ETFs is to focus more on making sure I'm consistently collecting option premiums over and over and over, and I'm not trying to make significant amounts on price appreciation. What does that remind us of? Oh yeah, our money markets used to give us consistent payouts but did not give us any price appreciation. I have been told that institutional fund managers use this approach to generate a very respectable return on the cash portion of their portfolio, and I totally believe it. The key to index ETFs covered options is learning to understand the trading ranges, or what I call the rhythms of the market. We want to be selling cash secured puts on the downbeat and selling covered calls on the upbeat. Now, I have used a metronome example, but this is a very slow metronome that may take a week or two or longer to swing from down to up. Last time I talked about the index ETF, I told you that you had to decide the trading range of the index you are looking at. But I have another approach I'm going to throw out tonight that you might like even better. I personally do use a gut approach to determining market ranges, but that is not for everybody, and especially if you're new and have not developed that gut, it may not work. It is a bit like chefs when they cook. They don't use recipes because they just know what works and what doesn't. But when you are just learning to cook, recipes are a much better way to start off. So tonight I'm going to give you a bit more of a recipe to follow, at least until you're ready to play with spicing it up. So here's a simple line graph of the daily closing prices of SPY for this year. The line connects the actual data points from each day, and it is just the close. Now let's add a line to this graph that is what is called a simple moving average, and you will sometimes see this abbreviated as just SMA. So if you've always wondered what SMA is, it's a simple moving average. So what the computers do is every day they average the last 20 days of closing prices, which gives us a new number that we can plot and look at versus every other day that we did the same average. It is called a moving average because every day we add today's price into the average and we drop off the oldest day that was used in the average the previous trading day. Okay, here comes the statistics. So everybody needs to take a deep breath, and if you got a cup of coffee, you need to take a big gulp and wake yourself up. So in addition to calculating the moving average, the computers can also crunch standard deviations. This is a statistical measure around how much variation there is in the 20 numbers that are being averaged. The good news, no, make that the really good news, is that you do not need to know how to calculate standard deviations. The computers will do that for you. What you may remember of your college statistics course, unless this lecture fell on a Monday after a full weekend, is that 68% of all the data is within one standard deviation of the average. But if you go up to 2 times the standard deviation, then 95% of all the points will be within a range of the plus or minus 2 standard deviations from the average. So you can see we have added 2 dashed lines representing plus and minus 2 standard deviations from the moving average. It's these kind of dashed red lines. And I guess before we go any further, let's see if there are any questions around this. I'm about to get into why this is important, but I just want to make sure everybody understands what we are looking at. So, Lori, are there any questions?
Nope, you're all set.
Okay, great. Okay, because some smart, cool dude named John Bollinger was the first to realize that these bands had real meaning in stock prices, we don't call these standard deviation bands. We call them Bollinger bands. But as the bard said, what's in a name? That which we call a standard deviation, my any other name would still be really sweet, or something like that. Some of what John Bollinger discovered is that when a price moves up close to the 2 standard deviation line, it often means it is about to reverse direction. Not always, but often. So you can see most of this year we have been trending up. But you can see we have bumped the top band a number of times, about 6 or 7 in 9 months, and almost every time we did, the market retrenched a bit. So we bumped it here, came back down, came up, bumped it, kind of went sideways, and then moved up again went sideways, and I'd consider the sideways a retrenchment of sorts as well. But often you see bounces off right away after it hits the upper band. We've not had near as many opportunities on bumping the lower band, but we did have about 1 a month in April, May, and June period. And the same phenomenon, once the band was hit, the price bounced or rallied. So you can see back here in April, we actually crossed it a little bit, but we immediately traded up for the rest of the month. Same in the middle of May, bounced off of it, hit it again at the end of May, beginning of June, and rallied quite a bit. So it's very, very common that if your prices are touching those bands, that you're about ready to see a trend reversal. So let's see how this can work for us. So what I'm going to work through is a series of trades that I did in one of my portfolios this summer. So I started with buying some SPY in March right around the 140 level. Then whenever the market was pushing to its upper bounds, I'd sell calls and collect premiums. And consistently the market would pull back and I'd buy the calls back at low cost and get ready to do it again. And you can see I did this a number of times through April, May, June, July, until finally in August I sold a call and it moved up and I was called away. So I owned the SPY for 5 months, and between dividends, which there were 2 of them paid during this time span, and collecting call premiums, I made 6% on my money for an APR of about 14.7%. That's what I consider a pretty decent interest rate on my cash. But let's say you're sitting with cash rather than having bought SPYs, and you say, so how do I get started? Well, what you want to look for are those periods like this when the prices are touching the lower part of your trading bands, and you immediately start selling cash secured puts. And let's remind ourselves on when the best time to sell cash secured puts are. It's when the market has moved down for several days, is down on the day, and close to a perceived trading bottom. And we're going to use the Bollinger Bands to help us understand whether we're close to that trading bottom or not. And you like volatility to be up, and you're going to hear about him in a couple weeks. Just accept that for right now. If you sell a put and hold it to the expiration the ETF is put to you, then you just turn around and look for the next opportunity to sell a call at a level that's higher than where the ETF was put to you. Once we have the ETF and we are selling a call on our ETF, we want to look for the optimum time to sell the call, and that's when the market has moved up for several days, is up on the day, is close to a perceived trading top, and again the Bollinger Bands are going to help us understand that. And we like to see the volatility up as well. And when your call on your ETF is exercised, meaning that your index ETF is sold, then you look to start selling puts again because you're back to cash. In other words, if we have cash, we start by selling to open and buying back when we can puts, and we keep repeating that until the index is put to us via an exercised option. Once it's been exercised and we own the ETF, then we start sell to open and looking to buy those back when we can, the calls. And we do that as many times as we can until eventually we'll sell a call and it'll get exercised and we'll be back to cash. And just like it says on our shampoo bottle, lather, rinse, and repeat. All right, so before we go out to the cool tool, Lori, are there questions?
Tana is asking, since SPY costs $144, that's an expensive option trade. Are there less expensive ones that might be similar?
That's a great question, and yes, I consider IWM as a good one to play as well, and it's about half the cost of IWM, or excuse me, of SPY, so it is a lower level. The other thing that is out there, and I don't know the timing on it, but they are proposing to allow selling mini contracts on several things, SPYs, IWM, Google, Apple, Amazon are all in there as well. And what that means is instead of having to do 100 contracts, or 100 shares in one contract, you'll be able to do a contract that only represents 10 shares. So I think we can look to see that, and I don't know if it's going to get done this fall or not until next year, but that's out there. But yes, the other one that I would consider very, very good for this opportunity is IWM, which is at least half the price of SPY. There are some others. I know Sharon has played with several other sector indexes. I personally haven't. I like to stick with SPY and IWM.
Paul, Ron Elliott is wondering if the 20-day average is the preferred SMA, and can you find Bollinger Bands for any other one?
That's a good question, and the answer to that is I like 20-day, and that's pretty commonly found. Sometimes there's 20 and there's also 50-day, And what I'm going to show you from the tool is there's a 20-day average Bollinger Bands, and then they also do 20-week averages in the Bollinger Bands on that, and they give you a little different information. So yes, there are other ones out there. Yes, you can pick whatever you want, but yes, 20 is a fairly standard one. Did that cover all of those?
Yeah. And okay, and Eric was asking, when in your first example, did your returns include price appreciation?
That particular trade, I actually lost a little bit rather than making money on it. I actually, once I got called away at a very small loss on it, which if it had been in a position that had a long-term holding on it, then it could have been a problem on the gains. But all of this was short-term, and it was all recognized. So it was short-term gains on the options and a slight loss on the underlying position. But that 6% does include all of that. So the small, I mean, I don't think it was less than, it's probably like a 1/4% loss on the underlying, and the rest was about 1% of the 6% was dividends, and the rest of it was all just call premiums. So the vast majority of it was call premiums.
Okay, Sharon is letting us know that even though you can't alter the Bollinger Band parameters, apparently John Bollinger actually has studied this, and he highly recommends the standard setting.
Okay.
It captures 90% of the price movements.
She's more of an expert on the technicals. I thought I had seen places where you could actually adjust it, but if she says you can't, you probably can't.
Were all your buys and sells at expiration Friday, or were those weeklies? Do you remember?
On the indexes, more times than not, I'm doing weeklies. Now, 1 week out of the month, it'll be the weekly actually is the monthly. But more times than not, I am just doing 1 week out. Anything else, or should we move on?
No. I mean, yes, sorry. No other questions.
Okay, great. So we're going to move into the cool tools. Again, just kind of a reminder, they're Excel spreadsheets. They work on Windows version of Excel. They do not work on Excel for Mac. Someday that may get fixed, but it still hasn't at this point. Once we get them kind of stabilized, that will be another thing I can look into. That's on native Excel on the Mac, and again, it will run if you run a virtual Windows box on the Mac, either through Boot Camp or Parallels or VMware Fusion. So, just a reminder, you need to allow macros and you need to enable external data. You can get the tools by clicking on the Resources and Tools link, and down in the lower right-hand corner you'll see all 3 of the tools. So the covered call tool, the cash secured put, and we've now added the index ETF cool tool. And I wanted to point out that all 3 have been updated this week. They all are now 2.10. There was a date problem on the other 2 that's been fixed. And so you might, if you haven't downloaded it already, you might want to pop out there and get the latest. And as we look at the tool and walk through some examples, just a reminder, they are for education purposes only. I am not making recommendations on stock to buy or sell, or on options to sell or buy. And again, we encourage that you do your own research or consult a professional before making investing decisions. All right, so let's go play. So this is the new tool. It will come up with the getting started just like the other 2. Same thing where you can change your commissions here, and after you changed and save it, then it'll remember that for the next time you come in. Okay, you can see it looks somewhat similar to the other 2, but there's some major differences. We have 3 buttons up here now. The clear data clears everything. but there's also a SPY button and an IWM button. Both of these two also clear the data, but if you click them, then it goes ahead and fills in the ticker and it just saves a step. So if you're doing a lot of SPYs and IWMs, it's just a nice, easy way to get going. So I clicked on SPY, and you notice once we move down to the fundamental questions, we have different questions now. And the very first one I'm asking is, what is the daily Bollinger Band? And if we click on our button, then we go out to a Google chart. This seemed like the best one for doing this. And you may have to tweak your settings the first time, and once you do, then this will definitely work in Google. When Lori tried this, she had to, and I'll show you how to do that in a second, but brings up our graph. We can see the high-low closes each day, and the blue line is our simple moving average. And then we have our Bollinger Bands. And what we're looking for, we clicked on the button for the daily, and you can see that's what we're looking at is the daily. And so what we're looking for is where is our Bollinger Band for the day that we're on. And it's sitting at an upper right now of 144, and I'd call the lower, I'd round down and call it 139. I think it's nice to look at both your dailies and your weeklies. So if we click the weekly and go out, and because we're in an uptrend, we see that the daily upper band is pretty close to the weekly, and that's what happens when you're moving up. So we're about 144 on the upper band, but on our weekly Bollinger Bands, which is averaging 20 weeks, you can see our lower is quite a bit lower, so we're at 144 and 128. And if you remember the last time I kind of did a session around selling options on index ETFs, and I was talking about looking for the bands in the market. You might remember that I talked about kind of an inner band and an outer band. And you get a little bit of that effect with the daily and the weekly Bollinger Bands, although when you've been moving hard in one direction, they'll pinch on the top side if you're moving up. If you're moving down, then they'll pinch on the downside. Next thing we have to decide, by the way, if you're doing SPYs, it goes ahead and populates what the next ex-dividend date is for the SPY, just so that you know it. So the minute we hit SPY, it tells us that next ex-dividend date is September 21st. That means if you want to own SPYs and get the dividend, you have to own them before September 21st. So September 20th would be the last day that you can buy SPYs, and you'd actually get to capture the dividend on the index. This next is a little drop down. You can say, well, what do I want to do? I want to sell calls or puts, and that's kind of a function of where you're at. If you have cash, then you click on puts, and it says, okay, how much cash have you got available for puts? And I'm going to say I've got 15,000 available. Next we come over, it tells us that it'd recommend looking for strikes below 139, and what that is that's the first lower band that we'd be hitting. So it picked that up from this daily Bollinger Band. And same button we had on the other two, we can pop out and look at the option chain. So we need to go down to the puts. And we're looking for a 139 put. And one of the things you'll notice right away is we have 1, 2, 3 139s. And if you'll study the date, you'll see, well, one of them is the weekly that expires this week. One is the monthly that expires next week. And then this third one is actually a quarterly option, and indexes do in fact have quarterly options traded as well, and I've actually allowed for being able to pick those in the Cool tool as well, and I'll show you that. But if we look at the 139 for September 22nd, we can see it's 24 cents. We go back, put in our 139, what expiration date. There's our quarterly I was talking about. What I've done, I didn't want to put them all at the top, but I've put the next one at the top. And if you want to play outer quarters, then the next 3 outer quarters are actually listed at the bottom of the list. We pick up September 22nd. What was it? 24 cents. And how many contracts? 1. And it says, yeah, you can end up only getting $9, and it's a 2% APR. So that doesn't look very good to me. When I do these things, I often will play a little bit, and so I might go back out to my option chain and say, well, I wonder what a 140 looks like, just out of curiosity. So here's a 140. It's 34 cents, so it's probably not going to be much better. So I think I'm going to skip that. Oh, the other thing I meant to look at, sorry, let's go back out there one more time, is it's sometimes good to go look at it like the next month out too, because there might be more volatility and the premiums might be better out a month. So if we went out to October and we looked at our same 139, and they're a little better on what the premium is, but it's a lot more time. So let's go back, put our 130 in. We're going to change to an October 20th and put in our, what was it, $1.11, $1.12, something like that. And we're getting close to our $100, but it's still a pretty low APR, so I probably wouldn't be attracted to do that either. If we clear our decks, and we can quickly throw these back in because we know what they are, and say, you know, actually I had some SPYs in my portfolio. I want to look at calls, and my basis on these calls were 142. Number of shares owned to, let's say, 200. It'll tell you, okay, you can do 2 contracts. So now let's go back out to our option chain again. And our first out of the money calls are going to be 145s. I guess there's actually a 144.50. I don't know what's up with that one. But let's look at the 145s. And let's go ahead and look at this Friday. So the 145s for this Friday are 57 cents. And so I'm going to put 145 in. And expiration date is September 14th, and the premium was 57 cents. And I'm going to do 2 contracts. And look at that. I mean, we've only got a couple days left, so the premium, the APR is extremely high at 63%. But I actually am getting close to my $100 target that I'd like to shoot for, so that might be an intriguing one to do. If we go back out and look at the 145s and move to next Friday's expiration, the 22nd, then we have 93 cents. Now, notice what it's telling us here is you're selling an option that crosses the ex-dividend date, so you run the risk of having your SPYs called away from you so that they can be the owner of record to be able to get the dividend. That's what that caution flag is about, and it's just as real on SPYs as it is on stock. Okay, so our APR is not as crazy good as the one for this Friday is, but we're now starting to pick up a pretty nice premium, $171, and we're certainly still above threshold level on the returns. So that might be an extremely interesting one. And again, just for grins, let's pop out and look at the, before we leave this, let's look at the quarterly. So September 28 is $1.10. So I can pick my quarter at the top and put my $1.10 in, and premium going up, but you can see I'm actually not getting quite as good an APR on that, so I probably would prefer to do the next week's rather than the quarterly. And just for grins, we'll do one last one. We'll go out and look at the Octobers. So October 20th, 145s, you're going to be picking up $1.81. And again, my APR has dropped. I'm only 12%. The money looks really good, but what you have to remember is I can go do my September 22nd, what was that, 93 cents? Pick up $171, and I still got several weeks to go where I could do that several more times before I get out to the October 20th. So that's where the shorter ranges on these indexes can be lucrative, because you can often do them week after week after week after week.
Paul, we have a couple questions here about what you just showed.
Sure.
One is, couldn't you maybe get the Friday $99 and then turn around and do another one next week for possibly another $99?
You sure could. That's a valid strategy.
Okay.
Now what you have to remember is, let's see, what was that guy, 57 cents? This is where it closed today. It may not be anywhere close to that in the morning. If SPYs are down $1, then you're not going to get 57 cents on that. But yeah, if first thing in the morning you could get 57 cents, I would agree that picking up that $100 might be a nice start, and I agree that if you can buy it back on Friday for cheap or let it expire worthless on Friday, then early next week you could sell the September 22nd. So yes, that's a very good strategy.
So Ivan is wondering whether, if you look at the current Bollinger Bands, does it seem like the trend is about to reverse?
It does to me. We are sitting at prices that are at the upper part of the band, which is typically where you'll see a reversal and start going down. So that's why I think it's a great time to be selling calls if you own SPYs already.
And along that line, Chuck Brunell is asking, and maybe you can explain what this is for everybody too, would you do a buy right since the price is near the upper band?
Well, and I don't know that I want to get real deep into that, but what you have to remember, Chuck, is that a buy right is it's exactly the same profit profile as a put. So if you're not willing to do a put, you really shouldn't be doing a buy right. And for people, what that means is you're buying the underlying SPYs and immediately going ahead and selling a covered call against what you just bought. That's why it's called a buy right. Buying this stock, or in this case the index, and immediately selling a covered call against it, or writing a covered call. There are times that buy rights make sense. They can be useful if what you're trying to do is make sure you capture the dividend. Because if you sell a put, you won't get the dividend, but if you do a buy right, you can, in fact, pick up the dividend. So there are times that it makes sense, but you just have to remember that a buy right is a synthetic put, and if you aren't happy doing a put here, you really shouldn't be happy doing a buy right.
Paul, do you consider events, Stanhouse is asking, do you consider events such as the Fed meeting on Thursday that might affect the S&P?
Absolutely. It colors my sense of whether I think we're going to see a turn in the direction of the market, and or whether it's driving volatility in the market. So I can't, without talking about each specific event, you can't say whether it's a bullish thing or a bearish thing, and it's often a function of whether you think the market's overreacting to it or underreacting to it ahead of time. But there's no question that major news events that are coming up are going to have an impact on both the market and because of the market, then obviously options on the market as well. Okay, let's go back in here for just a second. If we've got time, we may go look at some IWMs as well, but got a few little things I want to clean up on the. So I want to talk about our Coach cash secured put that we sold in August. We sold it for, it was a 52.50 put, expiration for September. Sold it for $1.25. Net collected was $110. APR was 26%. When we had the last Cool Club meeting, I was trying to get it bought back. Didn't get it bought back on that day, but did it the next day for 35 cents. So it turned out I probably could have gotten it for even much lower than that, like on the next day. But I did in fact buy it back, spent $50 to get it bought back. So my overall gain was $60, and the APR, because it was only, what was it, like 13 days, or 14 days, yeah, 14 days. So it was about half the time, and I got a little better than half the gain. So that's why the APR went up. And then we had a couple people that responded to and submitted their homework, and I really appreciate Chuck and Teresa for doing that, and just wanted to kind of go through. So this was Chuck's, and I think Chuck actually did this yesterday, but Chuck sold a cash secured put on Panera, and so this isn't quite right because it should have been yesterday's information, but looks like, from an optimum standpoint, it might not have been optimum. Panera looked like it maybe had already kind of bottomed and it was going up, so there might have been a better time to even sell a put. I don't know how many. Yeah, I do. Chuck did too, that's right. So I threw in what he must have had available for cash, and I don't know what he had as a buy price, but I threw 155 in. Yes, I felt like the price was going up. The next earnings date is October 22nd. So we were looking for strikes below 155, and I guess I put that in because that's what Chuck actually sold, was 155. Expiration is September 20th, collected $1, and because he did 2 contracts, up here it tells us we need $1.06, but because he did 2, he got to spread the commission over 2 contracts, and so we actually still ended up with a 20% APR. Picked up $185. That's exactly the kind of numbers we're looking for. Was it optimum? Maybe not, but I don't know. Maybe of the 4 stocks, he was just trying to get one done. It may have been the best of the 4. So I applaud Chuck for the effort. And then Teresa also turned in homework and did a great job. She not only sold a cash secured put on a line, but she also bought it back. And so, let's see, she sold an aligned put at the $34 levels strike for September 22nd expiration. She collected 65 cents per contract. Did it on September 5th. She did 3 contracts, so she collected $180, which was a 37% APR on the sale. And she was able to buy it back 6 days later at 10 cents. And so what she netted after she bought that back was $135. And so she bumped her APR from 37% up to 72%. Her cash is now free, and she can go sell a put on something else. So that's tremendous. That's really good. kudos to both of you guys. Questions on the homework?
There's a couple generic questions here. One is, why do you use Google instead of stock charts for the Bollinger Band? Is there any particular reason?
No. In fact, before I put this cool tool together, I had never used Google for it. There's challenges when you're trying to do hyperlinks in spreadsheets that they actually give you the desired results. And Google was the only one that I thought came close to actually giving me what I wanted to give you. So no, there's no reason, and if you're more comfortable looking someplace else, you don't have to use the hyperlinks out of the cool tool. You can go wherever you'd like to look at the Bollinger Bands. And speaking of that, we probably do need to go back to, do I even have a Bollinger open still? Yeah. Like I said, Lori had an issue when she tried this, and she had to go down underneath the chart on Google. There's technicals, and if there's nothing checked, you just say add technical, and then it'll let you pick from things. And Bollinger Bands is right there, and we could add it again. And okay, I thought so. So Google does allow you to use whatever period you want for the Bollinger. The default is 20, but if you wanted to look at a 20 and 50, let's say, then we can actually have both of the, well, it won't let you put both up, but it'll show you either one. So if you click on the cool tool and you don't have the Bollinger Bands, then that's all you need to do is go down to technicals and add it with it, and I'd recommend the 20 period. Now, did you have another question, Lori?
Yeah, here's a general question. If you don't have cable TV, do you have like sites on the internet that you recommend getting news from, to kind of general market kind of news? I
mean, there's a plethora of them. Wall Street Journal's good, and you don't even have to subscribe to the paid side. You can, if you do the Wall Street Journal, you'll get a good grasp of what's going on just watching the headlines that come across. I personally do tend to let CNBC run in the background. I very seldom really listen to the vast majority of what they're saying, but I like to have it on because I can pick up on intonations and know that something, there's something breaking, and that's when I'll tune in just to kind of understand what happened. And even those sometimes are more fluff than they are real, but that's kind of when I tune in, is when I can tell that it's not their normal pitch or tempo.
Laura Scott is also mentioning Bloomberg is good for market news.
Oh, that's great. Like I say, there's a bunch out there, and that's probably something we should open up to the, and maybe people are typing them in the chat. So if people have some favorites, throw them in the chat, share them with everybody, or send them to the Cool Club for that matter on what your favorites are. I don't by any means feel like I have a corner on what the best sources are.
So here's a question.
Anything else?
Ivan is asking, would you sell a cash secured put if SPY was right in the middle of the Bollinger Bands, i.e. not at the top or the bottom?
Well, I've probably done lots of wrong places, but yeah, I think you're better off to wait until it gets closer to the bottom of the band. It just gives you more room to negotiate, if you will, a better chance of it succeeding. But if you sell it in the middle and you get it put to you, to me, it's not that big a deal. You just start selling calls, so it's not disastrous. It's just trying to kind of decide what's going to give you the optimum in the short run. But if you're trying to be selling puts and just collecting premiums over and over again on your cash, then you're better off to do it if it's close to the bottom of the band.
Teresa's asking about Apple. she put a put on it this week, and didn't realize they were doing the new iPhone announcement. Would it have been better to wait for that until next week?
Yeah, on individual stocks, and it's even relevant on the news events on the broad market too, but individual stocks, when you know an event's coming, you need to know it's happening, for one. So that's lesson one, is any individual stock, you need to know anything relevant that's coming up. And then what you have to do is make an assessment on whether it's being either overhyped in the market ahead of it coming, or being under-recognized. And I see both happening on stocks, where I go, I think this actually is going to be something significant, but the market's not doing anything with it. Then you're going to play it different than, the typical thing on Apple announcements is they do get overhyped, and there's a lot of folks getting excited about it and buying it up ahead of the announcement, and it's kind of your traditional buy the rumor, sell the fact, and once the announcement's made, it often doesn't live up to quite the hype that's out there, and so there'll be a short retrenchment afterwards. And it doesn't mean, I think Apple's a great company and they do a lot of good stuff. It's just in the short term you see cycles like that where it'll trade up ahead of announcement and then trade off a bit after the announcement. So.
It's kind of, in a way, it's a scenario around an earnings announcement.
Yeah, yes, sure is. Exactly right.
It just adds some uncertainty into things.
And I know Teresa has done some of these too on Apple and Google. Both of those offer a lot of interest. There's a lot of volume. There's a lot of trading. There's a plethora of strikes. So you can kind of almost play them like the indexes. But I would always encourage you to never consider any stock like the indexes, because at the end of the day it is only one company and it can make much bigger moves than the broad market can. So the reason I do the income generation with the broad markets with the SPYs is because you just don't see days where it drops by, if broad market dropped by 10%, we'd all be pulling our hair out. But individual stocks can drop by 20 and 30%, and so they are dangerous to play with if you don't really understand the fundamentals around the company and aren't playing the fundamentals. So this income generation works a lot better on SPYs than it does on individual stocks. Let's see, we're sitting close to an hour, not quite midnight. I guess it's midnight somewhere. I just wanted to remind everybody that next week's session will be 9 o'clock Eastern, and we'll be looking at closing covered options with the ETF Cool tool. I didn't get anything written up on it, but as a homework assignment, I'd encourage you to try selling a covered option with the Cool tool, and then the homework assignment after next week will be closing that one. So get out there and try it. Try selling a SPY or an IWM, or if you got another index that you want to do, you can try those as well. I do want to go back just a second. If you go to IWM, I put in a little message that says go check. IWM is not as consistent on their timing on their dividends, so it isn't one that's predictable, so I can't fill it in, but you need to find out what the dividend date is. And if you clear the data and put somebody else in, like QQ, then I don't do anything with dividend date. And again, you need to be checking it and understanding when, if they're paying a dividend, and when it is. But that was just something I wanted to go back and clear up.
Paul, Aitana was asking if you could talk a little bit more about IWM. She said it seems more volatile than SPY.
It's definitely more volatile than SPYs, and that's because it's small caps. Small caps tend to move a lot more than the broad market, so they have more risk, and they obviously have more reward. To me, the place to be playing IWMs is when we've been in a close to a longer term bottom in the market. So March of 2009, after we had corrected so far, the small caps would have corrected even more than the broad market, and so that would have been a great time to be buying or playing IWMs. As the market moves up, I mean, if we look at market PEs, if you're down in the low teens on your market PE, it's a great time to be playing IWM. As you start moving up to kind of average PEs in the 16 to 17 range, you probably don't want to be playing IWMs, and you definitely don't want to be playing them if the market's sitting up at an 18 or 19 PE. Really, because if the market starts turning, your small caps are going to move down much, much faster than your broad market. So IWM is something to be playing when you're towards the bottom of the market. Since we spent a lot of time tonight talking about SPYs, I'm starting to worry that we're going to be in trouble. So I'm going to say good night from an undisclosed location.